Welcome to our video on assets versus liabilities. If you're new to accounting or investing, you may have heard these terms thrown around, but what do they actually mean? In this video, we'll be exploring the key differences between assets and liabilities, and why understanding these concepts is essential for evaluating a company's financial health. Before we dive into the specifics, let's start with a basic definition. Assets are things that a company owns that have value, while liabilities are obligations that a company owes to others. In other words, assets represent what a company has, while liabilities represent what a company owes. Assets come in many different forms, from physical assets like buildings and equipment, to financial assets like cash, stocks, and bonds. Some assets, like inventory and accounts receivable, are considered current assets, which means they can be converted into cash within a year. Other assets, like property and patents, are considered long-term assets, which have a longer lifespan. Liabilities, on the other hand, are the opposite of assets. They represent what a company owes to others, like debts, loans, and accounts payable. Like assets, liabilities can be classified as current or long-term, depending on when they are due. Current liabilities are expected to be paid off within a year, while long-term liabilities have a longer repayment term. So, why are assets and liabilities so important? Well, they are key components of a company's balance sheet, which provides an overview of a company's financial position at a specific point in time. By analyzing a balance sheet, investors and creditors can gain valuable insights into a company's financial health and growth potential. For investors, analyzing a balance sheet can help them evaluate a company's profitability and growth potential. By looking at a company's assets, investors can determine how much value the company has and how effectively it is using its resources. By analyzing a company's liabilities, investors can assess the company's debt levels and its ability to repay its debts. If a company has too much debt, it may struggle to stay profitable and may be at risk of defaulting on its loans. Creditors, on the other hand, use a company's balance sheet to assess the company's ability to repay its debts. By looking at a company's liabilities, creditors can determine whether the company is a good candidate for lending. If a company has a lot of debt, it may be seen as a risky investment and may have trouble securing loans or lines of credit. It's important to note that assets and liabilities can have a significant impact on a company's financial health. For example, if a company has a lot of debt, its liabilities may outweigh its assets, making it less attractive to investors and creditors. Conversely, if a company has a lot of valuable assets, its equity may be higher, indicating a strong financial position. Another important factor to consider when analyzing assets and liabilities is liquidity. Liquidity refers to how easily an asset or liability can be converted into cash. Highly liquid assets, like cash and accounts receivable, can be converted into cash quickly, while less liquid assets, like property and equipment, may take longer to convert into cash. Similarly, highly liquid liabilities, like accounts payable, are due in the near future and can be paid off quickly, while long-term debts may take years to repay. Liquidity is important to consider because it affects a company's ability to meet its financial obligations. If a company has a lot of highly liquid assets, it can quickly raise cash to pay off its debts or invest in new opportunities. On the other hand, if a company has a lot of less liquid assets, it may struggle to raise cash quickly and may be at risk of defaulting on its debts. Finally, it's important to note that a balance between assets and liabilities is key to a company's financial health. If a company has too many liabilities, it may be at risk of defaulting on its debts and may struggle to stay profitable. On the other hand, if a company has too many assets and not enough liabilities, it may not be using its resources effectively and may be missing out on growth opportunities. In conclusion, understanding assets and liabilities is essential for evaluating a company's financial health. By analyzing a company's balance sheet, investors and creditors can gain valuable insights into its profitability, growth potential, and ability to meet its financial obligations. Whether you're a seasoned investor or just starting out, understanding assets and liabilities is an important step towards building a successful investment portfolio.